It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. The last few weeks, I've been really hitting hard the points that the markets, in my opinion, are extremely overvalued. I should say it's not even my opinion. If you look at its many, many other opinions, and if you look at any marker of the market, regardless of how you measure it, we're at hitting all-time highs, in most cases, never seen before in the history of the stock market. I'm not going to belabor the point today. I think I've shared enough extensive information over the last 2 to 3 weeks that if you have any question or you want some more information of where the markets are at in the cycle, in my opinion, based on all the measurables, we are at the what's called the climax run of a bull market, which is typically the final and most volatile and dangerous portion of any bull market cycle. If you missed any of this, I'm going to strongly recommend going to yourpersonalbank.com website or the Your Personal Bank app. You can listen to this or any of the previously recorded shows. Each has its own topic, so you can listen to anything that may interest you. I've discussed a lot about the markets, as I stated, over the last 2 to 3 weeks, the recent IPOs that have come out, etc. Today, I just want to share a couple of quick little thoughts that I have not shared previously on the markets. And then what I want to move on to is a lot of the questions that people have been asking me that have been reaching out to me over the past few weeks. There's been a lot of great questions, obviously developing some new client relationships. All that is great stuff. For anyone that's going to reach out to me in the future, a lot of these questions, interestingly, are repeats, or in other words, I hear them over and over again. So the goal here is mostly to save yourself some time and myself. I'm going to cover a lot of these things about index growth annuity products, why it's the golden age of fixed assets, why it's the best time in over 40 years to look at these products. Literally, this is not hyperbole. This is not exaggeration. It's math. I'll share with you why that's the case. Before I get to that, though, like I said, I have a couple quick thoughts on the markets that I think are valuable to understand. One of them is Google just issued 100-year bonds to fund AI infrastructure. Now, that in itself is quite shocking. Google is a company that historically has been a cash flow machine, has funded most of its growth, and historically has bought back much of its stock, which is part of the reason why Google stock prices have stayed strong. And when a company's buying a good chunk of its stock back on a regular basis from its profits, that reduces the total amount of stock available, which obviously pushes the stock prices up. Now, these 100-year bonds, what makes it so shocking is Google is borrowing money today that it won't pay back in full until 2126. What Google is betting on is that artificial intelligence delivers returns beyond the next century. In my opinion, that doesn't seem like a lot of confidence, but more like desperation dressed up as conviction. And Google's not the only one doing this type of thing. Microsoft has invested somewhere around $190 billion, and their supply is already declining for the AI that they invested in. Meta, their free cash flow has collapsed by 90% in 2026, and it now is projected to be negative in 2027. And analysts are projecting over $1 trillion in spending in 2027. Much of this is now being funded by debt and future promises, not by profits like it was previously. And the analogy I've often referred to, because this is my 27th year in the financial industry, I was doing this and paying attention during the dot-com era. And the dot-com companies, by the way, were right about the technology. The internet did fundamentally change the economy. The problem is they were about 10 years early, and many of those companies lost tremendous values or even went bankrupt before it even mattered. In fact, during the dot-com era, Amazon dropped 95%, Microsoft 65%, and Intel 80%. There was a common saying back then that they were too important to fail. Yet many companies that said that did indeed fail. And now if you look at the Magnificent Seven, the top 10 tech companies, they now account for about 30% of the entire S&P 500. If they stumble, it is going to have a massive impact on the overall stock market. You see, the point I'm making here isn't just that Google is issuing 100-year bonds or that these other companies are spending so much money, which they are. They're also now no longer purchasing their stock. You see, AI spending does contribute to overall GDP growth, which is good. However, what has changed in 2026 is now the equity markets are being asked to fund a significant chunk of this annual investment. See, previously, private money, free cash flow from these companies, their profits carried much of the burden of the AI infrastructure cost, and the stock market enjoyed the ride. Not anymore. In the last 20 years, U.S. companies have purchased back about 12 trillion of their own shares. They've acted as one of the largest buyers of stocks in the entire stock market. This shift from companies being net buyers of their stock to now not purchasing all this stock, and on top of that, taking on debt to fund their AI infrastructure spending is a massive shift. The shift we're seeing over 1.2 trillion just in 2026 alone. Even if you compare to the 2000 dot-com bubble, this exceeds that time frame. So this shift from massive buybacks to record issuance represents a significant increase in supply of stocks. Basic Economics 101, supply and demand, usually tells the story. If you have a lot of supply, prices go down. If you have a lot of demand, prices go up. For approximately the last 20 years, there's been a lot of buyers, the companies themselves buying their own stock. For the most part, they're now stopping doing that. The question is, will there be enough demand for all this extra supply of stock to maintain the prices? And so far, at least, the answer is yes. Retail trading activity has been breaking every record on the books. Retail buyers set an all-time record in May of 2026, are tracking about 9% higher even in June. The trading volumes are nearly double what they were in 2020, the peak of the dot-com bubble. This current retail trading frenzy literally has no historical precedent. And that just brings me back to the very famous saying by Warren Buffett, "Be fearful when others are greedy, and greedy when others are fearful." We are seeing all-time levels of greed that have never been registered again in the history of the stock market. We are in a euphoric stage. Common sense and Warren Buffett tell you that probably should be fearful while everyone else is greedy. You should protect yourself. Index products give you that protection. Most people understand they have the downside protection. The principal is guaranteed, and any gains that you receive once locked in become new principals, so they're protected against future losses also. But what most people don't realize is that they fall into the common fallacy that if you want guarantees, you have to give up strong gains, and that is false. Now, I freely admit, index annuity products in particular have gotten somewhat of a bad rap in terms of poor performance. But as I point out to people all the time, if you bought a stock and it turned out that it performed very poorly, would you blame the entire stock market and say that it's bad? Well, of course not. That would be silly. You just picked a bad stock. The same holds true with index annuity products. Most of the time when I meet somebody who has had an index annuity, has had poor performance, the primary reason is they're in a poor performing index. they or their agent or advisor recommended an index that did not perform well. And there is software, I've shared this on the show many times before, index performance reports that show us the 1, 5, and 10-year history of these different indexes. And there are literally hundreds of them. And I can show you dozens and dozens of indexes that have averaged 10% plus average annual returns over 10 and even 20-year timeframes. We even have some that have averaged as high as 15% average annual returns over a 10-year plus period of time. The question I get asked all the time, and I'll expound upon this further in the next segments of this show, is why did my agent or advisor not know, or why was I recommended into these indexes when there are others that have performed so much greater? And frankly, the most common reason is probably lack of knowledge, lack of experience. Don't realize that these other options, these other indexes do exist. The second primary reason is most financial advisors and agents do not have access to the index performance reports. It's proprietary software. This is not public record. It's difficult to obtain. Even myself, early in my career, when I did not have access to this software and this information, I, like many others, were flying blind. Certainly you want your clients to do well. I think most agents and advisors do. And they try to pick the best indexes that seem like they will generate a good return. Yet they don't really have a track record knowing what these various choices have done in the last 1, 5, or 10 years, for example. And if you do meet with me, I will show you the difference. You're going to find that about 80% roughly our indexes are poor performers, low single-digit average annual returns. And that is the reason why most people, 80%, let's say, get poor performance with index annuity products. About 20%, though, have averaged solid double-digit returns consistently over a decade plus. I will show you those. I will show you the difference. And this is why when clients work with me, if they switch from a previous annuity, they typically double or triple even their average annual returns because we just put them in a better index. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the next segment. I got a few thoughts about the Federal Reserve. This is information I've not heard anywhere else yet, but I think it's going to play a big role throughout the remainder of this year. And then I'll get into the common questions and answers to help you understand how these index products actually work and why this is the best time in over 40 years and how you can take advantage of tremendous upside gains. Many other products, again, have averaged 10, 12, even 15% average annual returns over the last 10 and even 20 years, and eliminate your downside market risk. I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. Welcome back to the Your Personal Bank Show. You can reach me at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. I'm going to share a few thoughts here about the Federal Reserve. I have not heard hardly anyone discuss anything about this, and I think this is going to become a larger and larger and potentially a huge story in terms of stock and real estate markets throughout this summer and the rest of the year. I was chairman of the board of an FDIC-insured bank in formation for a couple of years. I still have a lot of contacts in the banking world. Probably have a better understanding or pulse on what's going on in that arena than most. And this is something that should concern every investor right now, whether you're a real estate or stock market investor. And that is the US CPI for the month of May 2026 printed at 4.2%. The third consecutive month of inflation accelerating. March was 3.3, April of 2026 was 3.8, and now in May, we hit 4.2. You've probably heard rate cuts, expecting rate cuts, talking about multiple rate cuts, and the stock market has priced that in. Many people are looking at purchasing a home or investing in real estate. We're waiting for lower interest rates to then purchase. I think that is now over. And there's two reasons why. One, I just shared, inflation is rising. The Federal Reserve will almost certainly will not lower interest rates while inflation is on the rise. But the other thing to be aware of is we have a new Fed chair now. And although recently the Fed decided to maintain interest rates at the same level, more interesting was the fact that 9 of the 18 Fed governors, they predicted an interest rate increase before the end of 2026. Half the Fed governors are predicting a rate increase. None are predicting a decrease. This will fundamentally shift the narrative around stock valuations, mortgage rates. If indeed you are looking to purchase a home, I understand interest rates are not that great right now, but I do want you to understand that before the end of this year, they could be even a little higher. This will also be a negative impact on the stock market in general. As the cost of borrowing increases, profits of companies decline. And it probably couldn't happen at a worse time. Particularly many of these tech companies that have been leading the charge in stock market valuations over the last few years, used to be cash generation machines, are now borrowing money at an incredible rate. Google is now issuing 100-year bonds. That's unheard of. Also, history tells us that inflation tends to happen in cycles. If we look at the 1970s, a famous period of time with high inflation, it peaked in 1974. Actually cooled down some, and everyone assumed the worst was over. And then a second wave hit in 1978. And by 1980, inflation had reached 14.8%. And that's when the Fed finally raised rates to 20% to stop it and kill it dead. More recently, 2 or 3 years ago, inflation peaked at 9% and has backed off into as low as the mid 2.5s. But now it's on the climb, as I stated, in May of 2026, hit 4.2%. Now, part of the reasons were the Iran conflict with oil, certainly, but there's other factors. Inflation comes in waves, so you'll get 2 or 3 waves of inflation, not one big event. So this is not surprising. And although recently there's been some good news in terms of the Iran conflict, oil seems to be coming down. Oil has started to flow through the Strait of Hormuz again. But we have a 47-year history of Iran, of them not necessarily following through on their promises. And are they going to revert back to their old ways again? I hope not. But history has shown us they can't necessarily be trusted at their word. So time will tell. Literally, this is day to day. We could be at peace or be bombing Iran again. And right now, it's just too early to tell and impossible to predict. So regardless of what happens, my point is simple. Inflation tends to happen in waves. As it's climbing, as it's been doing recently, the Fed will be much less inclined to lower rates. In fact, probably likely look to increase rates. The Fed has now dropped forward guidance. He even hinted that the dot plot that they used to put out projecting what they were going to do in the future would likely be changed or eliminated. So in other words, the market will have a lot less Fed forward guidance or outlook, which means more uncertainty. Uncertainty and volatility go hand in hand. So what I'm trying to say is welcome to the new Fed era, likely more volatility. The last thing I want you to understand again about inflation, the Fed has now officially announced they do not see inflation returning to its 2% target rate until 2028. And it may require them to raise interest rates to get inflation back down to their target rate of 2%. But Kevin Warsh, the new Fed chair, was appointed by Trump. The midterms are coming up pretty soon. Inflation is on the rise. Normally, you would expect the Fed to lower interest rates. Yet, their recent meeting, they held the rates. I believe personally the reason was political. Raising interest rates now in the summer would negatively impact the economy, stock market valuations, real estate, etc. And Trump and the Republicans do not want that negative economic news going into midterms. So if I was to bet on this, the reason why many of the Fed governors signaled that interest rates will likely rise before the end of the year means they'll probably do it after the midterms. They're probably going to do everything they can to hold rates where they're at, not cause too much negative economic impact going into the midterm elections. And then once that's done, all bets are off. Again, that's my opinion, but it sure seems like a very common sense way to go. Certainly, it appears that interest rates will not be on the decline and could very likely be on the increase. For the short to medium term, next few months to a year or two even, this is not a positive development for the stock market or the real estate markets or anybody that needs to borrow money. If you're looking at doing a loan, you may want to do it sooner than later. Interest rates likely will climb the latter part of this year. I know this is the opposite of what we were hearing, but sentiment has changed. The situation has changed quite dramatically, frankly. Now, if you want to protect yourself, if you're invested, you're at risk, and you want to protect yourself, this is the golden age of fixed assets. It's the best time in over 40 years, literally, for index products, growth products. We are seeing numbers we have not seen since the 1970s. This is the fact. This is math. We have many indexes, products that have averaged 10, 12, even 15% average annual returns over the last 10 and even 20 years. No downside risk. So the beauty of this is if the markets do continue to climb, great, you get to take advantage of that increase in what is likely the climax run, the final leg of a bull market that is both the most volatile and dangerous stage of a bull market. Yet, if and when the markets do correct, the principal is guaranteed. You don't lose. Any gains you lock in, you get to keep. We even have options that allow you to lock in at any time. If the story starts to change dramatically, like we saw in 2008 or in 2000, wasn't rocket science. See, the markets were crashing at those times. You could lock in your gains and not lose, and then re-engage when they recover. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I'm going to share some of the most common questions, misconceptions, and misunderstandings about index products and why they're so much better today than they were even 2-3 years ago.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. Now, a number of people have been reaching out to me over the last several weeks, have been responding to the message I've been sharing on this show, how the markets are at extreme valuations, numbers that we have never seen ever in the history of the stock market. And I appreciate everybody that's reached out. Many of you have had a lot of great questions. Most of you have looked at index annuity products at some point in the past. Some have those products currently, and others of you have never considered them ever before. Something I shared piqued your interest. Again, I appreciate all the feedback, people reaching out to me, wanting to learn more. Many have become new clients. It's a fun process. I love to educate, help people understand what they have better. I don't necessarily expect you to be an expert, but I do like you to at least have a good basic understanding so you understand what you have and why. Now, one of the number one misconceptions that I run into with people regarding index growth annuity products is if you want guarantees, you have to give up strong returns. Now, first of all, I want to say that is a total and complete myth. It's false. It's fake. Now, there's reason behind why that myth has come to be. I'll explain further why that is the case. But the reality is, it's not the product that's the problem. It's not the guarantees that are the problem of poor performance. The problem in most cases is people are invested in the wrong index. Or the second most common scenario I run into is they might have picked a good index, let's say an S&P 500, NASDAQ, or many others, but now they have a poor product that limits them on their growth. And the most common limiter I find are caps. And here's what I want you to understand, and what the most people, and what seems to me the most surprising thing from many people I talk to is there are a number of really good index annuity products available without any caps, no limit to the upside. And I'm going to repeat that again because I know many of you that have reached out to me, many of you that listen, have been told otherwise. I will show you dozens and dozens of index products with no caps. No caps means unlimited upside. Now, before I get into that in detail, I got to back up a sec and share with you the two game changers. And this will make more sense if you stay with me a few minutes. There's two game-changing things that I do for my clients that gives them the significantly more returns, typically 2 to 3 times more returns than they were receiving previously if they held an index annuity product, for example, and many times higher returns than what they were receiving even in market-based assets. Yes, I said that. Most of my clients beat the results that they were getting before, almost regardless of what they were invested in. Now, I'm not saying that to exaggerate or brag. I'm just stating facts and statements. Here are the two things. One, I'm independent. Why is that important? The industry states that about 10% of agents and advisors are truly independent. Therefore, about 90% are not. Now, I think personal history, it's probably much higher than that, but we'll go with the industry numbers. Why is being independent so valuable? Well, if you're not independent, you work with a certain group, you can only offer the products available offered by that group, which means you may or may not have the best product available. It's just that plain and simple. I can work with just about literally anyone. Now, I understand many of the agents and advisors that you have met over the years shared with you what they believed was the best product available. And sometimes that is the case, but most of the time I find it is not. It may be the best product that they have available, but it's not the best product available in the marketplace. And here's how you can tell the difference. When I meet with a client, I ask 3 key things: age, how much they want to invest, and what state they're in. And I do a search, and I do it with them. If we're doing a Zoom meeting, they watch me do this so you can see how the sausage is made. We do a simple search to determine what products indeed are available to you at your age, your state, and the amount you're looking to invest. And the results for most people are shocking. In most cases, there are anywhere from 2 to 3 to even 400 or more products available. Dozens of companies. Most people are shocked by that. They've never seen anything like this. And that, I point out, is a tell. If you've met with somebody previously, if you've had experience with looking at index annuity products or have one or have had one, and the agent or advisor did not show you literally dozens of companies and hundreds of products available, that is a good tell that they're probably not independent. It just makes sense. I'm not picking on those people. I'm just stating facts. If you want the best product available in the industry, in the country, or at least for your state, you have to have someone who's not only independent, but has access to all those products and willing to show you the differences. I did one meeting this past week for an 85 and 88-year-old couple. And for the 85-year-old, there was over 200 products available. Even for the 88-year-old, we had almost 100 products available. That shocked both of them. They didn't think there would be much available based on their ages, and there absolutely is. And many of those products available, we had some great options for them. For the 85-year-old, for example, we were able to show them a product that had averaged 11.2% average annual returns over the past decade. How many 85-year-olds do you know getting over a 10% return on their monies with no downside market risk? She was shocked, happily shocked. That's the difference. If you've looked at other index annuity products or you have one, I strongly recommend contacting me at yourpersonalbank.com. If you want to set up a Zoom call, great. We'll go over it and I'll show you everything's available. If you just want to send me your basic information and I can do a quick search, I'll give you an idea of some of the things that would be available. And literally, in most cases, there are hundreds. Now, again, why is this so important? If you're limited in your product offering, there's an old saying out there that says, if all you have is a hammer, everything starts to look like a nail. And I think most of you understand what I'm driving at. If you tell me you want to cut a board and I hand you a hammer, obviously the hammer is not a very efficient tool to cut wood. Now, is it the hammer's fault? No, of course not. It's not designed for that. You need a saw. And by having the full tool bag of all the tools available, do you need a hammer? Do you need a saw? Do you need a chisel? Do you need something else? We have all those things available. Let me give you an example. For some people, they want to maximize returns safely. So they want the product that's going to give them the best upside growth potential with no downside risk. Great. I'll show you those products available for you, for your age in your state. Because again, every state's different. And there's age ranges on some of these products. I've already shared, I had 91 products available for an 88-year-old this week. So that gives you an idea. We can work with just about everybody. But for someone else, time frame may be more important. There are products typically available anywhere from as short as 3 years to as long as 15 years. Now, what's the difference? We all know with a CD, for example, if you commit to a longer term CD, you typically get a higher interest rate. Why? You commit a longer time frame, the bank will pay you a higher interest rate. Index annuities operate no different. If you commit to a longer time frame, you're probably going to likely get a higher upside potential return. I'll share in a bit how companies with their products accelerate or decelerate. In other words, increase or decrease your returns. So a 5-year product, for example, will probably result in slightly less returns than a 10-year product. Now, for some people, the return is more important. Others, the time frame is more important. We have great 5-year products available, but also understand your overall return will probably be curtailed by about 20 or 25% versus the 10-year product, for example. These are the things I share with people openly, and as I state with them all the time, looking at these different products, I'm really agnostic about which one you choose. I'm not trying to give everyone a hammer. You told me you needed something different, so I'm going to find you the best tool for what fits you the best. Here's another very common scenario. I get asked all the time, what about a bonus? Do we have bonus products available? Absolutely. When I do this search, by the way, when we find 200, 300, 400 or more products available, what's really cool about the search is I can click on, say, time frame, and it'll immediately reshuffle the list, and it'll shuffle them by time frame, like I mentioned earlier, from 3 years to 15 years, the whole range. I can shuffle them by bonus or upside potential gain, whatever, and it just takes a few seconds. If you need a bonus, there are products available with 20% plus bonuses. I've seen some as high as even 29%. Again, depends on age and state, please understand. But even for the 85-year-old this past week, she had some other assets with a penalty. I was able to show her a 22% bonus product. She had like a 2% penalty to get out. So if she does decide to switch, she'll be up like 20% day one. That's pretty cool. And that's for an 85-year-old. For somebody younger, there's even more options available. My point is simple. Are there bonus products available? Absolutely. I'll show you dozens. But here's the thing that you should understand about bonuses. There are no free lunches. If the company's going to give you a big bonus, like a 20, 22, 25, I've even seen 29% bonuses, obviously they're going to take something away. And typically what's taken away is your upside potential growth. They're going to curtail or cap your growth upside. I do have uncapped options with big bonuses. The upside growth is going to still be good, strong, but not as strong as a non-bonus product because, again, they're paying you 20% bonus up front or more. Let me use an analogy that I think often fits. Let's say you have two runners, and they're going to run a race, a one-lap race, and one runner gets a big head start. So they get to start like at the 3/4 mark. The other runner has to run the entire lap. Well, the one with the big head start, of course, is the bonus product. They're getting like a 20, 25% head start. But they're going to run at about 2/3 speed of the non-bonus product, the one that has to run the entire lap. So what happens? The gun goes off. Both runners start running. But again, the runner that has to run the entire lap is running about 1/3 faster. What's going to happen? Oh, the first part of the race, the one that had the head start, the bonus product is going to be ahead. And about maybe halfway through the race, the faster runner is going to catch up. By the time the end of the race occurs, the faster runner is going to win by quite a large margin. And if you continue that race, obviously, eventually they'll lap them. They'll double the amount of money. So the rule of thumb I find is with bonus products versus non-bonus, a non-bonus product with a good index will catch up to a bonus product with a good index at about year 4 to 5, typically. So if you're looking at, say, 5 years or less, a bonus product can make sense. If you're looking at 5 years or longer, a non-bonus product is probably the better option. I show you both of these. Again, I'm agnostic. I don't care which one you choose. I'm looking for the best tool for you. The last reason why bonuses are often used is if you happen to be in a product that has a penalty or tax liability or something like that. Could be a CD, it could be another annuity, could be some other asset. Well, the bonus could offset that cost or that loss, like this gal I was sharing earlier this week. She had a 2% penalty to get out. She was 85, 2% penalty. I showed her a 22% bonus product, so she'd be 20% head day one. And her being 85, having that much more money in the account 4 or 5 years was appealing. So there are times and places for bonuses to be used, but I find in the industry they tend to be overused. Use them as a selling point. And again, they may be the better option or they may not. Depends on your time frame and your goals. So I shared the first major game changer, what I do for my clients, being independent, having access to all the different products, showing you hundreds of products available, literally dozens of companies, all the different scenarios, bonuses, time frames, you name it, which ones have the most potential upside so we can find the best product for your goals. Stay tuned in the next segment. I'm going to share with you the second big game changer of why my clients average 2 to 3-fold more returns than what they got previously. And this one's even bigger, so don't miss it.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. And yes, you will reach me. Now, in the first segment, I shared one of the two major game changers of why I am able to typically have my clients average 2 to 3 times more returns than what they were receiving previously, particularly with index annuity products, but oftentimes even with market-based assets, you name it. And yes, I said that. It is true. Comparing statements of what's actually happening, real numbers, net, in your pocket, because that's what counts, right? If you missed the last segment, and it was about being independent, having access to the best products that are available, that fit your goal, what you want, whether it's a time frame, maximum returns, you need a bonus, whatever, we can get the best available period. Only about 10% of agents and advisors are independent. That's what the industry states. So it's a really big deal. If somebody you worked with before or looked at this before didn't show you literally hundreds of products and dozens of companies, even if you're in your mid or upper 80s, they're probably not independent. That's a really good tell. Now let me share with you the second major game changer of why I'm able to increase returns so substantially for my clients typically than what they got before. And this addresses directly the common myth that index annuity products suffer from poor returns. And it's all about the indexes. There are hundreds of indexes. Most of them are proprietary, private. There's no way to know what returns are. An agent or advisor has no idea what the index has actually performed over the last number of years. So frankly, even myself, before I had access to these index performance reports, I was flying blind just like everyone else. This, folks, is a huge game changer. I get a proprietary index performance report monthly on hundreds and hundreds of indexes showing us the 1, 5, and 10-year actual average returns of these indexes. Now, I get asked all the time, why doesn't everyone have this? Well, this is a program put together by a specific company that focuses on the, as they call it, cream of the crop, the top producers. They look for people that have been in the business for a decade or more, literally done millions and millions of dollars of business. They don't want everyone. And this is a carrot that they use to recruit people to work with their organization. They tell me less than 1% of agents and advisors have access to this. And because it's a carrot to do business with them, they don't want everyone to have it. There's your answer. That's why everyone doesn't have it. By the way, it's not common knowledge. I've had a number of clients and prospects reach out to their previous or current advisors and ask the question about what about the index performance report on these indexes. And most cases, they just get a blank stare. They are unaware that this information even exists. I didn't know about it either years ago, earlier in my career. Now, I'm not picking on these other agents and advisors. I'm just stating a fact. I suffered the same thing, lack of information. I just didn't know any better. I believe most agents and advisors want their clients to do well, try to put people in the best options, but they don't really know. They're flying blind. So one of the things I do with prospective clients, with you meet with me, we do a Zoom call, yourpersonalbank.com, you can schedule it. I will show you this index performance report that gets updated monthly, and I'll show you the hundreds of indexes and the 1, 5, 10-year results, what they've actually produced. And one thing becomes immediately clear when we do this. When we look at the 10-year average annual returns, for example, about 80% of them average low single-digit returns. And about 20% of them have solid double-digit returns. 10, 12, even upwards of 15% average annual returns for 10 years plus. Why the difference? It's not any different than the mutual fund industry. It's common knowledge that the S&P 500 index beats 80% roughly of mutual funds every single year. Yet billions and billions of dollars are invested in these mutual funds. The same is true in the index world. One comment that I hear often is, well, just because one particular index, say, average 10 or 12% or more, doesn't guarantee it's going to do the same thing next year. That is true. Which is more likely to happen? You have an index that's averaged 10, 12, 13% or more even. Average annual returns for 10 years plus. You have another index that's averaged about 3% a year on average for the last decade. By the way, folks, there's lots of those. And maybe he's never done more than 5 or 6% ever in any given year. What are the odds next year that the poor performing index is going to outperform the strong performer? Really, really low. The odds are strongly in your favor that the one that's consistently outperformed and done strong will continue to do so, versus the one that's never done it before suddenly popping up and say, hey, here we go. I mean, it does happen, but it's pretty rare. So obviously, we're going to steer you towards the indexes that are the strongest performers. And the analogy I use all the time is, if you want to win a horse race, you need two things. You need a fast horse and a good jockey. The horse is the index. You want a racehorse. You don't want to be invested in a plow horse. And here's what I want you to understand. If you have an index annuity product or an IUL, there is an 80% chance the indexes you're invested in are plow horses. They're poor performers. There's about a 20% chance that they're strong performers. If you want to know the difference, I strongly encourage you to contact me at yourpersonalbank.com and we can compare. And most people are shocked by the difference. The difference isn't a little bit more. The difference typically is double or triple. I have even seen 10-fold increases with clients of mine. I've had 2 in the last month that had index products for about 9 years in both cases, that in the first year, when we did their annual review recently, the first year they made more returns than they had the previous 9 combined. Now, I'm not going to guarantee that with everyone, but that gives you an idea of the difference. Now, I shared the analogy of you want to win a horse race, you got to have a fast horse and a good jockey. The horse are the indexes. Obviously, you want a racehorse, a good, strong, fast horse, not a slow plow horse to win a horse race. You got the wrong index. And that's the number one reason. That's the number one reason why most index products perform poorly. Oh, one last thought on that before I go to the next piece. I get asked this a lot. Why do the companies offer these indexes? Frankly, I don't really know why some of these indexes are offered by some of these companies because I think it reflects poorly on them. I only have to go by common sense. And common sense tells me, I can't prove this, but they're probably getting some kind of benefit from the index company to offer that index. Does that make sense? Again, I can't prove it. We've discussed the horse. You want a fast, strong index to run that race if you want to get good, strong returns. Let's talk about the second part, the jockey. What is the jockey? That is the product itself. Now, a good jockey obviously can accelerate a horse or rein it in, slow it down. And one of the most common reining in or restrictions that I see with index products are caps. I have literally had several new clients, prospects, tell me they've met with agents and advisors that told them that all index annuities and IULs have caps. Folks, I'm going to stand here and tell you that is completely false. There are dozens and dozens, if not hundreds even, of index products, both IULs and index annuity products, with no caps. None whatsoever. What does that mean? Unlimited upside. No cap means unlimited upside. I love no cap products and what we typically recommend. Nearly all of my clients have no cap index products. Now, there's 2 other pieces to the jockey or the product that are important to understand. Caps is one. That restricts your upside. You don't want any caps, or if you have one that's really, really high. If you have a cap under 10 or 12%, it's too low. You need to contact me and I'll show you a product with no cap. Secondly, fees. Fees are easy to understand. You want low or no fees. High fees take away from your gains. We have a lot of no fee products or low fee products. Now, sometimes they're an advantage to have a product with a low fee, and I'm talking about 1% or less. If you're paying, here's the second thing. If you're paying more than 1% in fees, total fees on your product, you are paying too much. You should contact me at yourpersonalbank.com. I'll show you dozens and dozens of options with less or even no fees. I'll explain why having sometimes low fees makes more sense, but I've got to explain this last part first, and then I'll put it together. We talked about caps. You don't want any caps, or you want really high caps. Anything below 10% is way too low. I wouldn't consider anything under 12% a year, frankly, and I prefer no caps. Fees, you want low or no fees. Anything over 1% is too high. Contact me if you have that. Third is participation rates. What are participation rates? It's the percentage you receive of the gains of the index. Let me use an example. If an index goes up 10%, for example, in a year, and you have a 100% participation rate, you would be credited 10%, assuming you had no caps and no fees. If you have a 70% participation rate and your index went up 10%, you would get credited 7%. 150% participation rate, and yes, those exist and higher, and your index went up 10%, you would get credited 15%, assuming you had no caps or fees. And again, we have those products. Here's my point. I'll put it all together. What are you looking for? You want to win that horse race. You want a good, fast, strong horse. You want a good, strong index. I'll show you all the different indexes available. There are hundreds. I'll show you the ones that have performed 10, 12, even 15% average annual returns, 10, even 20 years. You want a good jockey, one that's going to spur the horse on. You want to have a product with no caps. I'm just going to tell you that straight up. I'll show you dozens and dozens of those. You want a product with little or no fees. We have lots of no-fee products. We have products with 1% or less fee. Anything above that's too high, in my opinion. And you want a product with good participation rates. Typically, you want to have at least 100% participation rate and often even higher. We have products that have 150, 180% and above participation rates. I'll show you 200% participation rates. But again, it's not just about the participation rate or just about the index or just about the cap or lack of one, obviously, or the fee. It's a combination of all four things. We want the best of all four, the best combination of all four. And the best product, index annuity product I've seen in my 27-year career, it's with one of the largest annuity companies in the country, A+ rated, about strongest financials as you can get. They've had a good, solid index annuity product for years and years. And in the last 20 years, the lowest return on the indexes that we recommend, combination of the horse, the jockey, no cap, unlimited upside, low or no fees, strong participation rates, the lowest we've seen actual returns, and this was investing through the Great Recession in 08 and 09, the lowest return was 7.67% per year for a decade plus. So over 7.5% average return, net in your pocket. That was the worst. You want to know what the best was? 15.5% average annual return over 10 years, net in your pocket. Yes, we have years where people have made 20, 22, 27% in 1 year alone, but also no down years, no negative years. The downside is protected on all of these products. So what I'm saying is the best product I've seen in my 27-year career, if you had invested in this, based on the last 20 years of returns, your returns in your account, net of everything, would have been at least 7.5% to upwards of 15% per year on average. Most people average somewhere between that. 10, 11% is sort of the norm of the average returns. If you're not seeing that, with no downside market risk, remember, don't forget that, tax deferral, if you have not been receiving that over the last few years or decade or more even, you should contact me at yourpersonalbank.com and I'll show you exactly what I'm talking about.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.